Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am going to talk to Mr. Tom Braegelmann today. He's the CEO of GCA Equity Partners, an accomplished entrepreneur, fund manager, and private lending mentor, offering a wealth of experience and knowledge gained during his 30-plus year career in real estate investing, commercial construction, land development, and private lending. Oh my God, he's got a lot. I feel like a baby now. But also he's an author. So that was pretty interesting. Here's a really interesting book, which actually I want to talk about as well so that I understand. So today we want to focus on mastering real estate investing and why someone needs to master or what someone has to do. So welcome, Tom.
Thank you. Thank you. Great to be here. Thank you.
Absolutely. So Tom, I always start with this question. Tell us something interesting or funny about yourself.
Well, I grew up on a small farm in central Minnesota. I had a large family, learned how to work, and had a great upbringing. Didn't have a lot to fall back on, but other than, not a lot of money and things like that. But yeah, basically learned how to work. I'm very grateful for it now. At that point, I was feeling like, like, why do we all have to work?
Don't we all?
Right. And so I'm really grateful for that. Boy, I can't really think of anything too wild and crazy, but it's been a good lot of years that I've lived so far.
That's awesome. And I think it's a great point that you mentioned that during the childhood and the early childhood and teenage years, a lot of things we complain about, but those are the traits, those are the things which define us. Those are the things which will propel us forward, right? It's so important.
Yeah, that's so true. And just the fact that you hear a lot of stories about people who had really tough childhood experiences because of things that may have happened. For me, it was a lot of work, and we didn't always enjoy that piece of it, but had a great family, great upbringing.
That's what matters, right? That's great. So how and when did you start investing in real estate?
I started right out of, actually, while I was in college. I bought my first duplex.
Nice.
Yeah. And I bought it with owner financing. That was back when interest rates were 18-20%.
Right. Yeah. I don't think people will believe you when you say 18-20%. When my friends, they all are investors, they reach out and they say, oh man, I'm getting 4.5% interest. It's too much. Like, do you even remember 12% used to be an average interest rate? Come on.
Yes, right. No, that it created some great opportunities for owner financing because there were no other options. There just was no property selling or people weren't able to buy because interest rates were so high.
Right.
And so, so that's how I started and bought that first duplex in college, moved into one unit and upgraded it, moved into the other one, upgraded it and brought tenants into the first one. And then the duplex right next door came up. So I ended up having two side by side. So that was really my first.
And how long ago was that?
That was back in 1980.
My God. So you did something which has become famous by bigger pockets right now.
Yeah.
One is you did owner financing.
Mm-hmm.
That's amazing. Second, you did BRRRR because you did rehabbed and renovated. The third thing you did is house hacking.
Yeah.
That's amazing.
No, we did a lot of owner financing. As a matter of fact, I was listening to one of your podcasts just recently, and your guest mentioned the BRRRR strategy. And like he said, he had never heard of it before. I had never heard of it until just recent when Bigger Pockets sort of branded it or named it.
Exactly. Yeah.
But no, I probably did 90 contract for deed or owner financing type of product.
Very nice. Oh, that's awesome. Yeah, you and I need to chat. I need to learn how to get owners to the table to do owner financing with me.
Yeah, there's definitely some cool creative ways to do it.
Right. So let's talk about, because you mentioned mastering real estate investing. Can you define what do you mean by that?
So mastering real estate, as in with the book, you mean, or just in general?
Yeah, with the book and in general as well.
Yeah. So the book that I wrote, it's called Mastering Real Estate Investing with Private Money. And what I wanted to do is create a book that I wish I had when I started out. I finished it up about a year and a half ago. I finished up the book. It took me a while to write it, but what I wanted was to fill it full of investment lessons that I had and techniques and strategies that have worked for me. And my son was just getting involved in real estate at the time. So between myself when I was in college as the avatar and my son as the avatar, those are the two people that I was writing it for. But really, it's a 7-step process that I take the reader through, whereby it starts out with talking about why we want to invest the way we want to invest. There's a real estate investing spectrum of you can invest completely passive, you can invest completely active, or you can team up and have both sides come together. The active investor with the deal, the passive investor with the money, have them come together. The goal of the book is to teach people exactly how to do it themselves, whether they want to be on the active side or the passive side. They can do it themselves without the need for the bank, without the need for me or facilitators. They actually can learn how to do it themselves using this process.
Oh, that's pretty cool. And I'm going to read the book as well. So in the book, though, you mentioned about defining a roadmap. So how can one define or how can one go about defining a strategic roadmap?
Well, I think it really starts out with understanding what is the real reason that we want to invest in real estate. I know from my experience, I loved the idea of owning more real estate, more and more. And I started out, like I mentioned, with a couple of duplexes, eventually built a pretty nice real estate portfolio. And at that time, I just loved buying homes and either fixing them and selling them, or buying them and holding them, that combination. And that worked out really well for me. In the book, I talk about how I got my butt kicked in the downturn and had the opportunity to start over. At that point, I was pretty burnt out on owning real estate. And what I really liked about real estate was all the things that you can do with it, but you don't need to own it. And so you get all the benefits by being the passive investor. And so that's really what I talk about in the book, was to share with people that find out what it is that you really want. Why is it that you want to invest? And then is real estate the best model or the best vehicle to use? And so if we can find out that first, and then the second step would be to find out what tools do we have in our tool chest that are needed to bring that sort of a strategy together. Because every project has the deal, the money, and all the work it takes, facilitation it takes. So it takes a team to bring it all together. If we can take inventory on what we have, what we're good at, what we enjoy doing, what we have a passion for, and bring others in to fill that gap, we can do so much better than if we try and do it on our own. And so I talk about the cycle of abundance and how the more we give, the more we get back. And the fact that if we're willing to work together, we can create a team where everybody's interests are aligned. And with that alignment of interest, it reduces the risk and increases the chances of profitability. That's really the key. It's really important to get to that point of understanding what we're doing and why we're doing it, not just buy real estate because somebody's real estate is the thing to buy.
Yep. No, that's a great point. And I believe in creating team as well. And you and I both do syndications, right? Mm-hmm. So that it's all about team, right? And overall real estate is a team sport. You want to get together with like-minded people who have complementary skills. And that's how you can create the right team, right?
Absolutely. And the team is so critical. One of the lessons I got to learn was how important team is. I would say to date, I've never funded a bad real estate deal, but I have funded some teams that have not necessarily performed as planned. Right. And so they did not go well. And I talk about them in the book because I really want to give examples of what to look for and what sort of landmines there are out there if we don't have the good solid team and the processes in place.
I agree. Another thing I saw was why investment guidelines. Why is setting investment guidelines important?
Well, it's especially important. Well, it's important across the board, but especially important when one is starting out, because there's a tendency to, and I see this a lot, where borrowers or active investors with deals will come in and they'll be looking, they have a deal that they really like, and which is great, but without the guidelines and the investment criteria of what you're going to follow, it's super easy to get caught in what I call the rose-colored glasses syndrome of, well, this is just going to be such a sweet deal. It's going to look look really great when it's
Right.
done. It's going to be just the perfect thing. So not only don't fall in love with the project or the investment, but really look at it from a very objective perspective based on the criteria that you've set before you ever get started. And I think that's step 3 in the 7-step process. And that is setting very clear criteria so that when something comes in, when a decision needs to be made, it's not made on emotion. It's made on rules and guidelines that you've set for yourself to stick with all the way through.
That's such a great point, right? Because a lot of time, and that's why real estate is one way it's not emotional. Of course, you can still get tied to that property or investment, but it's not like stock market where it's all emotion based, right? You're watching the market, it goes up, you feel good, it goes down, you feel bad, and then you want to get out of the investment. So that way I like real estate because it's so illiquid. It could be emotional, as you said, but at least I can't get in and get out next day. If I see my property's price dropping on Zillow, I can't just get out next.
Exactly.
Right. But you're right. Don't get connected emotionally to that investment or that deal.
I would add that's very true for both the active investor who finds the deal and the passive investor who's looking to invest with someone or with a team that is doing the deals. By having that really clear set of guidelines to go to, you don't get swayed by the emotions of somebody who's able to really talk up a deal or whatever it might be. It really is basing it on facts more so than emotion, which is super critical.
Right. No, that's a great advice as well. What do you mean by creating safer deals? Like, how can one create a safe deal?
Well, what comes to mind for me for that is I go back to the point of funding. Like I say, I don't think we've ever funded a deal that's been a bad deal, but we funded some bad players in teams that were supposed to perform. And so the way to get around or to really cover that risk is by having the criteria, the deal underwriting criteria, the team underwriting criteria, being able to dig in and really know what to look for when you're looking for the risks in the deal. Risks come from unknowns. Unknowns come from complexity. If we can get into projects where ideally, they aren't super complex. Even if they are complex, though, if we can identify the complexities, then we can identify the risks that come with those complexities. And then we can either mitigate or eliminate the risks. And if we can't, we must not do the deal. I mean, that it really just comes down to that basic standard, knowing exactly what to look for, where the risks are, what to really, just what is it that you're trying to aim for, and having that written down, your criteria, your underwriting criteria, and then being able to follow through with identifying the risks and mitigating them. Super critical.
I agree. There is no doubt.
Mm-hmm.
So, and you also mentioned about that you created some rules for investors. Can you share those rules for, let's say, start with active investors and then passive investors?
Yeah, it really it boils down to again, it's in the criteria in my book, and towards the end, right at the end of the book, I give like the 10 commandments of the active investor and 10 commandments of the passive investor. And just the gist of that is what it takes to be a team player and to watch out for each other. Because if I'm an active investor and I get a passive investor that's hard to work with, or that is super unreliable, funds don't come in when they need to be, or if I'm a passive investor and I'm working with an active investor who doesn't perform or is having challenges, if I'm not able to work closely with that other party, it creates more risk. And that communication between those two parties is what makes the deal either work or not. It's a difference between a profitable deal and a deal that goes sideways or loses money.
Right. And does that same thing apply to passive investing as well?
Yep. It's just as important. If I'm a passive investor looking to invest with an active investor, I have to see and I have to know what it is that's going to make, what can I bring to the table that's going to give that active investor all the opportunities that they need to make it a successful deal, right? And so if I'm the passive investor and I'm not supplying the cash fast enough for the deal and the deal starts to stall out, or if there are issues that come up, maybe there's an issue with the contractor or certain things happen, if I'm the active investor and I share that with the passive investor, together that solution can be brought in and likely can be resolved before it becomes a bigger issue. So that communication and the guidelines of how they work together is super critical. There's so much to be able to have. I don't know if I should use this analogy, but it's kind of like a prenuptial agreement. It's like you really want to be able to think everything through that might be an issue.
Right.
Maybe not even a prenuptial agreement, maybe even more just a business working relationship. You want to try and think of anything that might happen, where the wheel might fall off.
Yeah, anything which can go wrong, right?
Yeah, and just try to and think it through all the way through the end. If this happens, what's the resolution going to be, and how are we going to be able to make it a good resolution so that we can both walk away, maybe with a couple of scars, but not by killing each other, right? So you really want to be able to have the foresight and the vision of what the possible issues could be and plan for them.
That's great. Thank you for sharing those, rules or advice. What kind of deals do you work on now?
We do mostly joint venture type of deals more so lately. It was 2010 is when I got on the passive side of the equation where we started facilitating the deals. Before that, I had been doing a lot on my own, but since 2010, up till now, originally when I started on the lending on that model, we did a lot of where we were just strictly the lender.
Okay.
But halfway through, about 5-6 years ago, we decided to get to the point where we're a little bit more of a joint venture type of a structure because it creates a tighter working relationship with that active investor. And so basically what we do is we bring passive investors with money that don't want to do the work but have the money and the busy professionals to the people that have deals. And we are the oversight, the facilitator, bringing the deal together. Because of the experience we have, we do the underwriting, we set the criteria, we have all of that built in place.
That's awesome. Can you talk about one of your best real estate investment in last, let's say, 15 years?
Best one. The ones that I like the best are the ones that are simple. And one thing that I would say is that I would even go as far as saying there's this myth that in order to have good high returns, it increases the risk, or that there's always the risk reward ratio.
Right.
There are ways of setting up deals where they can be super low on the risk factor scale by comparison, but because of the way they're structured, there are ways to set it up so there can easily be double-digit returns. I mean, and I'm talking things like, I don't know if the listeners are familiar with the term loan to value. I'm sure a lot of them are, but loan to value, it can be a super low loan to value, and still, if the deal is structured properly, it can easily be in that double-digit returns as long as you structure the deals properly. And so, what I like are the deals that are shorter, the ones that are low loan to value, but still have that element of what I call forced appreciation, where there's work done to increase the value of the project. And so with that, I guess I would say there's transactional funding, there's dough for a day type of funding, there's a number of different strategies where you can get in and get a quicker, higher rate of return with even a lower than typical risk factor, as long as they're set up properly.
And what kind of real estate, assets are those? Are these single family, multifamily, or any kind of real estate?
It's pretty much across the board. We don't do any owner occupied, but we've structured the smaller fix and flip type of property all the way through luxury homes, new construction. We've got projects in Napa Valley that we're doing right now, multifamily, even land development. I know there are a lot of private lenders or hard money lenders that stay clear of developments, but there again, it's in how the deal is structured. I think that first phase, new construction, residential developments can be, in my opinion, can be structured in a way where they're lower risk than even a moderate renovation single family home. So it all depends on, it's knowing again what the risk factors are, being able to mitigate or eliminate those risks, or stepping aside and not getting involved with the deals.
Got it. And can you share your worst real estate investment or deal? Or which didn't work?
Yeah, and Well, one that comes to mind is a project we did in Southern California, and it was in Malibu.
Oh, wow.
And
Okay.
it was a combination of city restrictions and a borrower who was not competent. We found out this was an early on project back in 2010, 2011. I think it was 2011. And it just turned into a nightmare. And what we ended up doing is my business partner, Chuck, and I ended up just going in there, having to finish the project ourselves. We
Oh, wow.
did a lot of, and our offices at that time, we have an office in Campbell, California, or San Jose, California.
Uh-huh.
And like right now, I'm in San Juan, Puerto Rico, because we have offices in both places. But at that time, we did a number of trips where we ended up going from San Jose down to Malibu just to get that project committed, because we were so committed to getting it done, because we didn't have any other options at that point but to really take the bull by the horns and just let the borrower sort of sit on the sideline. And the project in the end turned out really nice, but it wasn't enough. So
okay, but at least it wasn't a money losing investment.
Yeah, and I
had losing though. I'm pretty sure.
Yeah. I mean, when I think about projects that have not gone as planned, it really has 90% of the time just been in some element within the team that didn't work out. And the experience that we've had, it was a lot of lessons learned in 2010, 11, 12, 13. And what happened was I got spoiled back in Minnesota, where I was doing all of my real estate investing. I had a really super stellar team there. And I made the assumption coming to California, well, of course, they say they're going to do it. They show that they've done deals in the past. Why, of course, they're going to do it. But that was not the case. That was an expensive lesson that I got to learn.
Welcome to California.
And I'm not saying California. I'm just saying it was just,
no,
I think
I'm
what happened is I think what happened was I had a super stellar team in Minnesota, and I didn't appreciate it well enough, I guess.
Yeah. No, this was awesome. Let's take a quick break, and after the break, we'll go to the same questions I ask every guest.
All right.
You're listening to the Wealth Matters Podcast. The Wealth Matters Podcast. For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. Tom shared a lot of golden nuggets about how to master real estate investing. Tom, are you ready for fire round?
I am ready. I'm ready.
What do you think about the real estate and stock market, as both of them seems to have hit the peak?
I think that the real estate market is going to level out. I don't think we're going to see anything like we did in 2008, 2007, 2009. I think both are going to have a correction, but I don't think it'll be nearly what it was back then.
Right.
That's just my guess.
Yeah, I think I agree, because a lot of it has to do with inflation, which is not going away, right? So of course, the loan criterias and whatnot have been way stricter than 2005, 6, 7, whatsoever, right? So
yes.
Yeah, but there has to be some kind of correction just to make them affordable.
Yes. Yeah. No, that's what I would say.
Would you be changing any business or investment strategy after this pandemic is over?
It won't really change a lot of what we're doing, I don't think, because we've worked our way through the entire process. It didn't affect us a whole lot. We had a lot of projects on our plate, and they continued through the process or through the pandemic. We're working on taking part of our company public, so that's scheduled to happen in September. And if that does, that would be a change, at least somewhat of a change in our model. But I think we'll still continue with a lot of what we're doing right now.
Good luck with that. That's awesome.
Thank you. Yeah, it's exciting. It's a whole new world from what I'm used to, but it's fun.
Favorite real estate or finance or any other related book other than yours and mine?
The books that I remember are the ones that were early on, and they had it was cash flow. I can't
Cash Flow
remember
Quadrant by Robert Kiyosaki. Yeah, that
was one.
Right?
Yep, that one's good, especially because it really gives a good basis. It's a good teaser on a lot of fronts, because it'll get people to, at least my experience is it triggers the mind to come up with different options of what's possible.
That's great. Any tool or website you recommend or you cannot live without?
Let's see. I would say, I guess, I mean, the Zillow, a lot of the comparable the comp sites that we work with, the Redfin, a lot of those things. Yeah, I'm drawing a blank on that one.
Any advice for beginner investors?
Yes, that one I definitely have an answer, an opinion on. Whatever it takes, team up on your first deal, your second deal, your third deal. Team up with people who have already gone through the process and made their own mistakes that you can learn from. It's too risky to get involved in real estate on your own unless you have the experience that's needed. And typically, if you're a beginner, doing it with someone, doing it with a team, and really learning from that. And I mean, in the book, one of the biggest elements in the book that I talk about is the profit sharing model. And I would much rather get involved with a project where I share profits with the other party and have it go really well than to get involved with a project that I get 100% of and don't make any money on.
Right.
So collaboration, there's plenty of, if the deal is done right and it's vetted right and put together right, there's plenty of money there for everybody at the table to make some good money on it.
I totally agree. How do you give back?
I like giving back by mentoring. I've done meetup groups back in San Jose. We had a little over 4,000 members in our meetup group.
Wow.
And I really enjoy the teaching aspect. And it's for two reasons. One is, I definitely feel good about it. I love helping people. But the other is that it really helps keep my skills sharpened, keeps my skills honed. If you ever really want to learn something, teach it to other people. And it forces one to articulate and really be clear about the messaging and the methods and processes. So
that's such a great point. I didn't think about it, but you are right. When I'm teaching others, I'm always thinking I'm always on my toes. I have to make sure that I know it, right? No, that's, I didn't think of it that way.
Yeah, I've learned a lot through mentoring.
How can my listeners reach out to you?
Let's see, if you go to Mastering Real Estate or masteringre.com, we have a short quiz that, well, basically, we're starting an investment club, and I'm working with our marketers. I just made some notes here. Working with our marketers this last week and this next week, where we're starting an investors club. If anybody wants to get involved with that, where we show deals and investment opportunities, kind of give a first look at the investments, by going to the website, masteringre.com, there's a brief quiz there that will help you determine where you really fit on that real estate investing spectrum. At the beginning, we talked about the spectrum of active to passive, and there's all the way in between. So you can be active with only the deal and little or no money, or you can be passive with no deal and money that's needed to fund it. So any place on that spectrum. The goal with the quiz is to help the person taking the quiz to identify where they best fit in that investing spectrum. And it helps give insight as to what would be the best opportunities or the best way to get what they really want, not what they think they want of owning real estate, but maybe the benefits of owning real estate.
That's awesome. Thank you so much for your time today, Tom.
Absolutely. It's been a pleasure.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing.